Looking into how Next finances its operations and how its cash flow has changed between 2024 and 25. Next relies on a combination of equity financing, long-term financing through debt, and strong internal cash generation to support the business. In earlier periods, shares were issued to support acquisitions, while more recent years focused on buybacks. Alongside this, long-term bonds and bank facilities provide predictable sources of external finance. The business continues to benefit from strong operating cash flows, which are supported by supplier credit, a common feature in retail, where trade payables act as short-term financing. Between 2025 and 2024, operating cash rose slightly from around 1.12 billion to 1.13. This shows a very stable performance. Investing cash flows remain consistently negative due to ongoing investments in technology, logistics, and infrastructure. Financing cash flows fluctuate depending on buybacks and dividends and debt payments. Despite these movements, Next still achieved growth in its cash balance, showing that its underlying cash generation remains completely robust. When we look at Next financial position across 2 years, we can see a balance of strong foundations and the areas to watch. On the strength side, the company benefits from strong rising cash flows, low gearing, and solid liquidity position. These factors give the business resilience, flexibility. Next also has high investment capacity, allowing it to continuously upgrade its operations. At the same time, its working capital management is efficient, supported by effective supplier relationships. However, there are weaknesses to consider. Rising inventory levels could present a risk if demand slows. The business is also highly dependent on its capital expenditure. This means that it must reinvest regularly to stay competitive. At times, equity financing can dilute existing shareholders, and some of Next's strong cash positions is influenced by its favorable supplier terms, which may not always be guaranteed. Overall, the company shows strong performance, but also faces ongoing operational pressures. There are several important limitations when comparing Next financial results. Firstly, major acquisitions made in 2024 significantly distort the comparison of investing cash flows because the spending in that year is definitely not typical. Secondly, IFRS 16 lease accounting inflates assets and liabilities, making trend comparisons with earlier years less consistent. Retail seasonality is another key limitation because next year end is just after the Christmas period when cash inflows are at their peak. The company's liquidity can appear stronger than it may be at other points in the year. Finally, one-off transactions such as acquisition payments or large share buybacks, as I mentioned before, can distort underlying trends and make it harder to assess the company's long-term finance performance. So it's important to interpret the results and factor this in mind. Finally, to finish, we wanted to reflect briefly on benefits of working together as a group. Unfortunately, we weren't able to all do it together in the final recording due to a lot of technical problems, but we did work well together. We are previously course mates. Communication was very easy from the start, and we were easily able to organise our tasks and quickly support each other in the group project as we get on very well together. Working together also meant that we could combine our different strengths and share our understanding of this topic as we have already done, which helped us deepen our analysis and improve the quality of the final presentation, which we did last week. And we all looked at each other's scripts and discussed what could make them slightly better or what we could say slightly different. And thank you very much for listening.